A country's trade balance, which is the difference between the value of its exports and imports, significantly impacts its economy. It's a key component of a nation's gross domestic product, GDP, and influences various economic aspects, including economic growth, employment, currency value, and national debt. Here's how a country's trade balance affects its economy. 1. Trade surplus. Exports-imports. Positive economic growth. A trade surplus generally contributes positively to GDP. When a country exports more than it imports, it means there's a strong demand for its domestically produced goods and services in international markets. This leads to increased production, which in turn fuels economic activity. Job creation. Export-oriented industries tend to expand when there's a trade surplus, leading to job creation and potentially higher income levels for workers in those sectors. Currency appreciation. A trade surplus often strengthens a country's currency. Foreign buyers need to purchase the exporting country's currency to pay for its goods, increasing demand for that currency, and thus its value relative to other currencies. Increased national income. The country earns more foreign currency from its exports than it spends on imports, which can lead to a net inflow of wealth. This extra budget can be used for domestic investments or foreign investments to create new income sources. Potential drawbacks. While generally positive, persistent trade surpluses can sometimes lead to higher prices and interest rates. Strong demand can push up domestic prices, inflation, and interest rates. Trade tensions. Large, sustained surpluses can lead to trade tensions with deficit countries, as they may view it as an unfair advantage or a threat to their domestic industries. 2. Trade deficit. Imports-exports. Negative impact on GDP initially. A trade deficit means a country is spending more on foreign goods and services than it's earning from its own exports. This can initially be seen as a drag on GDP, as it suggests a reliance on foreign production rather than domestic. Potential job losses. Industries that compete with cheaper imported goods may suffer, potentially leading to job losses and unemployment in those sectors. Currency depreciation. A trade deficit can weaken a country's currency. There's less demand for the domestic currency, as more of it is being exchanged for foreign currencies to pay for imports, leading to a depreciation in its value. This can make imports more expensive and exports cheaper over time, which might help to correct the deficit. Increased foreign debt. To finance a persistent trade deficit, a country may need to borrow money from foreign countries or international organizations, leading to an increase in national debt. Benefits in certain contexts. It's important to note that a trade deficit isn't always inherently negative. In some cases, it can indicate strong consumer demand. A high volume of imports can reflect robust consumer demand and a strong economy where people have the purchasing power to buy foreign goods. Investment in future growth. If the imports are primarily capital goods, machinery, technology used for productive investment, a trade deficit can contribute to a more productive economy in the long term. Emerging markets often run trade deficits as they build infrastructure and industries. Access to cheaper goods. Importing cheaper goods can lower prices for consumers and businesses, improving living standards and potentially freeing up resources for other economic activities. Factors influencing trade balance. Several factors can influence a country's trade balance. Exchange rates. A stronger domestic currency makes imports cheaper and exports more expensive, potentially leading to a trade deficit. A weaker currency has the opposite effect. Domestic and foreign income. Higher domestic income can increase demand for imports, while higher foreign income can boost demand for a country's exports. Trade policies, tariffs, quotas, and other trade barriers can influence the trade balance by making imports more expensive or restricting their quantity. Productivity and competitiveness. A country's ability to produce goods and services efficiently and at competitive prices significantly impacts its export potential. In conclusion, the trade balance is a crucial economic indicator, but its implications are complex and depend heavily on the underlying causes and the overall economic context. A trade surplus generally signals economic strength, while a trade deficit can point to challenges or, in some cases, reflect healthy consumption and investment patterns.